In the early going, the Q3 earnings season has greeted investors with reports from the financial sector and others. Strict attention is being paid to what the financial institutions had to say about the state of the consumer and the economy. And some consumer related stocks have also reported they too had a story to tell. Our research director, Shiraz Mian, is here now to help interpret those reports for us. Shiraz, let's start with those consumer related stocks. I'm thinking of Pepsi, Walgreens, and Delta. What did those results have to say about consumer demand?
So on the whole, Terry, everybody has been positively surprised as to how resilient the economy has been and how resilient consumer demand has turned out to be. Now, a number of these companies and then others, while saying demand still remains strong and stable, are saying some cautionary stuff about the time ahead. Not in terms of things falling off a cliff, but slowing down relative to where it has been in Q3 and in the first half of the year. So it's as good as one could have expected at this stage in the economic cycle, with the extraordinary magnitude of Fed tightening that has gone through. But all in all, it's a pretty impressive showing for the economy and household finances.
On the flip side, there were the reports from the big banks. The bank stocks seemed a little bit mixed in their reports, at least to me. Any insight there on those reports about the consumer and the economy, especially how corporate America is dealing with the higher interest rate environment?
Yes. So a whole variety of different cross currents with bank earnings, as I've been writing about in my earnings commentary as well. But what they are saying about consumer isn't significantly different from what the consumer-facing companies, like what you mentioned, the Pepsis and the Deltas of the world, are saying about household finances either, and they see some trouble ahead. They see some signs of stress, particularly at the lower end of the income distribution. They are seeing the delinquency rates going up from the historically low levels where it has been in recent quarters, and that's something they are interpreting as signs of weakness and moderation going ahead. There is weakness in, or moderation or deceleration in demand for loans as well. But all in all, given where we have been through in terms of tightening, it's a pretty impressive showing. The bank earnings, particularly on the net interest income side, has across the board a surprise to the upside.
And so, is that how you describe, based on those reports, the resilience of the sector in this higher for longer rate environment?
I think so, yes. I think the market the stock market that is, has been unusually negative on the sector. These stocks have been really beaten down, some for good reasons, but for many others, I believe it's that question of throwing the baby with the bathwater type of thing. If we do get into a recession, and it's a bad one, then it would make sense for financial stocks to struggle at this stage. Like if we were heading into a recession. As you know, I've never been on board with that thesis, and I always thought there were fundamental sources of strength in the economy that will keep us afloat and keep us in the positive. So yes, higher for longer is a problem for these companies as well as for the economy. But as long as we dodge the very negative outcome, and once that view becomes mainstream, is internalized, the market will realize that many of these stocks are really good buys.
Early expectations by some on the street was for the financial sector, by the way, to gain in the 8% range this time around. And that would be the fourth highest growth rate out of all of the sectors, according to published data. Are we going to see that?
It's going to be better than that. And that's what I was referring to when I said that the core banking business, the net interest income, has proved better than expected, and not just for Q3, but many companies talked up the outlook on that front for Q4 as well. So in the final reckoning, I believe finance earnings growth will be in double digits compared to the 8%. So overall, results from the group have been better. And this goes on to the overly negative sentiment on the sector as well. Coming in, sentiment was so weak that as results came in better, it positively surprised everyone in the market.
So what about the rest of your scorecard? How's that looking?
So including all the numbers that came out this morning, Terry, we now have results from 78 S&P 500 company. That's a little over 15% of the index as a whole. Earnings growth is 1.6%. Revenue growth is 5.7%. 80.8% of the companies are beating EPS estimates, and 62.8% are beating revenue estimates. This is moderately better than what we had seen from these 78 index members in other recent quarters. So on the whole, the tone and substance of reports is better than expected.
How about guidance and margins? How do they stack up?
So we know that on the top line, as inflation moderates, it's still positive, but it's decelerating. That has it pressures revenue growth, which has been a big positive on the earnings front. But on the other hand, it also pressures the line items, expenses. So margins have held up a lot better, and they're still weak year over year, continuing the trend that we have been seeing for a while, but better than expected. And companies continue to be pretty good with sustaining and maintaining their profit margins.
And based on what we've seen so far, is corporate America seeing signs that maybe there's an end to that earnings recession people were talking about?
Yes, it's becoming clearer that the declines are coming to an end. In fact, Q3, which is what this earnings season is for, is currently expected to be a decline of 1.7%. Ex-synergy positive 3%, but then from next quarter onwards, from Q4, growth turns positive. And from what we have seen thus far, and the management commentary that we have heard thus far, it increasingly is becoming clearer that the period of earnings declines that we went through in recent quarters is coming to an end.
Do we have to be concerned about a low bar being set this time around?
That's not the case, actually. As regular readers of our commentary know, the revisions trend ahead of the start of the Q3 earnings season was very positive. In fact, outside of a sector or two, estimates barely budged since the quarter got underway. And we are seeing something similar at play for estimates for Q4 as well, meaning estimates did not fall that much for Q3, and they aren't falling that much for Q4 as either. So on the whole, one could say, in fact, that estimates are on the higher side. That's what one would have interpreted the revisions trend to means for Q3, and that's what I would say for Q4 as well.
Overall, then, how would you characterize the Q3 earnings up to now?
I would say positively, positive, reassuring. We had for some time been saying that the earnings cliff narrative that was in the mainstream some time back has been put to bed. It's no longer anything more than just a fringe view. And the picture continues to stabilize and improve. Yes, there are risks, and yes, there are odds of something negative and different than what we are projecting. But it increasingly is becoming clearer that the economy will be able to dodge a nasty recession. That notwithstanding the negative effects of higher for longer, we will have just nothing more than a moderation in economic growth, and that's all good for earnings and the stock market.
All right, we'll be checking in through the Q3 earnings season with you. In the meantime, we always invite our listeners to check out your written commentary on earnings, which changes twice a week, generally Mondays and Thursdays on Zacks.com. And something else for our listeners to check out, Zacks Technology Innovators gets in on the early and hot and inevitable trends in technology, and you're invited to follow this portfolio's buys and sells in real time for the next 30 days. Go to Zacks.com/promo for details. With Shiraz Mian, I'm Terry Ruppolo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.